We are now going to look at the valuation considerations that relate specifically to mergers and acquisitions. So please note, in this section of the lecture, you are going to be valuing the target company. And the reason why you need to value the target company is to determine the purchase price, or what's often referred to as the purchase consideration or the bid price. And please note, this part of the lecture builds onto the concepts that we already covered in our lecture on valuations. So if we are trying to value the target company, if the shareholders in the target company are minority shareholders, you should then perform a minority valuation, meaning you should use Gordon's dividend growth model. On the other hand, if the shareholders of the target company are majority shareholders, you should then perform a majority valuation using either earnings or free cash flows. If the target company is not a viable going concern, then you should use the net asset value method to perform the valuation, and you will obviously base that on liquidation values. So there's nothing new there, guys. We covered all of that in our lecture on valuations. That's just a recap. What is new and important for this lecture is you need to know the difference between general synergies and specific or unique synergies. Now, guys, general synergies are synergy benefits that are known by all bidders. So let's say, for example, we have company Z over here, or let's actually not confuse things. Let's call this company T. This is the target company, and the shares in this company are for sale, and let's say there are 3 potential bidders. So there's 3 companies that are interested in purchasing the shares of the target company. Company A, Company B, and Company C are all interested in purchasing the shares in that target company. Now, general synergies are synergies that are known by all bidders. So all of these bidders over here, if they know about the synergy benefit, then it is a general synergy. However, let's say in the example that you are looking at, you are not aware of Company A or Company C. You've been given this information over here, and you've been told Company B is interested in purchasing shares in the target company. You don't know anything about the other bidders. If you are given specific synergy benefits that relate to this specific company buying the target company, those are then specific or unique synergies. Now, I know when I'm explaining it now, it doesn't sound very different, guys. I am going to quickly jump to a lecture example and show you. You'll see when I get to the lecture example, it's very clear when you're dealing with a general synergy or a specific or unique synergy. For now, I just want you to understand, if it is a general synergy, then it means all potential bidders, so all companies that are interested in purchasing the shares in the target company, they know about those synergy benefits. On the other hand, if it is specific or unique, then it is directly attributable to the acquirer and target company. So in other words, it's a synergy benefit that will only arise if Company B buys the shares in the target company. A specific synergy will not arise if Company A buys those shares in the target company. So the specific synergy is specific to these 2 companies, and it will not arise if the other 2 companies buy the shares in the target company. So like I said, right now it sounds like a mouthful. Trust me, I'm going to make sense of this, and by the time we are done with this, you are going to know what I'm talking about. Just give me a few more minutes and you'll be with me, I promise. Then, please note, when it comes to calculating the value of the target company, it depends whose perspective you are looking at this from. If you need to calculate the minimum value, you are then looking at this from the perspective of the target company's shareholders. And the minimum value is the minimum price that they will be willing to sell their shares. On the other hand, the maximum value. When we calculate a maximum value, we are looking at this from the perspective of the acquiring company. And it is the maximum price that the acquiring company will be willing to pay for the target company. Then lastly, we also have the fair market value. And the fair market value is not seen from the perspective of either the acquiring company or the target company. Instead, it is the fair value of the target company in the open market. So please note, guys, if you are required to calculate the purchase price of the target company, or if you have to value the target company, you can calculate three different values. You can calculate a minimum value, a maximum value, and a fair market value. There are three different values you can calculate, and it depends on whose perspective you are performing the valuation from. When you are calculating the minimum value, you do not take any synergies into account. So if there's any general or specific synergies, you ignore them. You don't take them into account. When calculating the maximum value, you then take general and specific or unique synergies into account. So you take both general and specific or unique synergies into account when calculating the maximum value. However, when calculating the fair market value, you only take general synergies into account. You do not take specific or unique synergies into account. And when performing all of these calculations, everything must be done net of integration costs. All right, guys, so there was a bit of an overload of information over here. I now want to jump to the lecture example. Let's work through the lecture example together, and then you'll see everything on this page is actually pretty straightforward. All right, please go to lecture example 1. And in this example, I'm going to show you how to calculate the minimum value, the fair value, and the maximum value in the case of a merger or acquisition. Fury Limited has recently indicated their interest in purchasing 80% of the shares in Lawson Pty Limited. All right, so we have Fury Limited wanting to buy 80% of the shares in Lawson Pty Limited. Fury Limited has identified the following synergies and costs which would be applicable to the acquisition. So first we have immediate retrenchment costs would amount to 650,000 Rand after tax. These employees would be retrenched as Fury already has staff filling similar positions due to the similarity between Fury and Lawson's business operations. So because the two companies have similar business operations, they are going to retrench some employees at a cost of 650,000 Rand after tax. Now guys, this retrenchment cost is obviously a cost and not a synergy benefit, but we are looking at synergy benefits and costs, all right? So this is obviously a cost, not a benefit. The benefit will come in a little bit later because there will be salary or wage savings as a result of this retrenchment. But for now, we are looking at the cost. So what I want you to do is I want you to tell me, is this a general cost or a specific or unique cost? Now remember, if it's a general cost, it means that regardless of who the acquiring company is, if any old random company comes along and buys shares in Lawson Pty Limited, they will have to incur that cost. That means it's a general cost if it relates to any acquirer. On the other hand, if this cost is specific or unique to Fury buying Lawson, then it is a specific or a unique cost, obviously. So, you tell me, is this a general cost or a specific or unique cost? Look at what you were told. The reason why they are going to incur this cost is because Fury already has staff filling similar positions, and this is due to the similarity between their business operations. So this is not a general cost that would be incurred if any acquiring company buys a Lawson Pty Limited. This cost is being incurred because of the similarity between these two companies. So it is specific or unique to Fury purchasing Lawson Pty Limited. So this is a specific or unique cost. Then, as a result of the retrenchment, there will be annual after-tax wage savings relating to the retrenched employees at 450,000 Rand, and that is at current prices. Okay, so those are the annual wage savings, and that is after tax and at current prices. And you are told that future wage increases would have grown at 6% per annum. All right, so we'll look at that when we get to our calculation. For now, I just want you to tell me whether this saving over here is a general saving or a specific or unique saving. Now, if it's a general saving, it means if any acquiring company buys the shares in Lawson, they will have that saving. So any old company can come along, buy the shares, and they get that saving. Then it's general. If that saving is specific to Fury buying the shares in Lawson, it's then specific or unique. Now, guys, the reason why the employees are being retrenched is because of the similarity of their business operations. So if the retrenchment cost was specific or unique, then this saving over here, which is as a result of the retrenchment, is also going to be specific or unique. So this is a specific or unique synergy. We then have legal costs relating to the acquisition. At present value are expected to be 600,000 Rand after tax. And this is based on a recent quote for a similar industry transaction. So this is not specific to Fury Limited purchasing Lawson Pty Limited. This is based on a similar industry transaction. If any company buys the shares in Lawson Pty Limited, they are going to incur legal costs as a result of the acquisition. So this is going to be a general cost. We then have due diligence costs, which will be incurred prior to the transaction date, and are expected to be 560,000 Rand after tax. This is also based on a recent quote for a similar industry transaction. So once again, guys, this is not specific to Fury purchasing Lawson Pty Limited. This cost will be incurred if any company purchases the shares in Lawson. So this is going to be a general cost. Then monthly marketing costs of 40,000 Rand before tax would be saved next year with a 5% annual escalation. And this is due to the similarity of advertising campaigns of Fury and Lawson. So obviously, if this is because of the similarity of their advertising campaigns, this saving is going to be specific to Fury Limited buying shares in Lawson. So this is a specific or unique synergy. Some land and buildings would be sold for 2.5 million Rand after tax, and this is applicable to any acquirer. So it's not specific to Fury purchasing the shares in Lawson. If any company purchases the shares in Lawson, they will have this, or they will sell the land and buildings for 2.5 million Rand. So this is going to be a general synergy. You've then been told that the weighted average cost of capital has been estimated at 14%. The management accountant of Fury Limited performed the following valuation of Lawson Pty Limited. So the valuation has already been performed. The target company has been valued, and you can see they've taken a control premium into account, and the reason for that is because Fury is going to be buying 80% of the shares in Lawson, so they are valuing a controlling interest over here, so that's why they've added a control premium. They have also deducted a marketability discount, and that is because Lawson is a Pty Limited, so that has already been done for you. So you've got the value over here of Lawson Pty Limited after taking into account the owner level premiums and discounts. and this is referred to as the intrinsic equity value. It excludes all possible synergies and integration costs. So all the synergy benefits that are described above and the integration costs that are described above are not included in this calculation. We are now going to look at how you should include the synergies and integration costs in the calculation. First, I want you to calculate the present value of all general synergy benefits and costs. So ignore the specific or unique synergy benefits and costs for now. We are just focusing on general synergy benefits and costs. So if you go back to the information provided in the question, we already marked everything off. So the first general cost that we had is the legal costs relating to the acquisition at present value are expected to be 600,000 Rand after tax. So you have already been given the present value and the amount is after tax. So you can just take that amount, that is the present value today, it is already after tax, so it's cash flow 0, and those are your legal costs. And that was a general cost. Now please note, guys, the direction of your cash flows must always be correct. So obviously the legal cost is not a synergy benefit, it is a cost, so you need to show that as an outflow. Then the next general cost is the due diligence costs, which are expected to be 560,000 Rand after tax. So once again, include the due diligence costs, 560,000 Rand, that is already after tax, and you show it as an outflow. It is a cost. Then we had one general synergy, and that related to the land and buildings that would be sold. So some land and buildings would be sold for 2.5 million Rand after tax. Okay, so you're quite lucky here, everything has been given after tax. That would obviously be an inflow. It is a synergy benefit, the sale of land and buildings. All right, so calculate a subtotal over here, and that is the present value of all of the general synergy benefits and costs. Then next, I want you to calculate the present value of all specific or unique synergy benefits and costs. So once again, go back to the information provided in the question. So first we had the retrenchment costs. Immediate retrenchment costs would amount to 650,000 Rand after tax. So once again, the amount is already after tax, so you don't need to worry about anything there. We've got the retrenchment cost. The direction of your cash flows must be correct. So because this is a cost, you show it as an outflow. Then next, we have after-tax annual wage savings of 450,000 Rand at current prices. Now, please be careful. You can't just say it's a saving of 450,000 Rand and that's your present value. That is not correct. This is an annual saving. So it's not a once-off saving. This is a recurring saving. So we need to perform a perpetuity calculation. Guys, you can see this is different to the sale of land and buildings. With the sale of land and buildings, they would have an inflow of 2.5 million Rand, but that's once off. It's not recurring. This is a recurring or an annual wage saving. So we need to perform a perpetuity calculation. So what am I talking about? You're going to follow the logic of Gordon's dividend growth model, where we calculate the present value by taking the future expected dividend and dividing by the cost of equity less growth. Now the only difference is the terminology changes. You aren't working with dividends and you're not working with the cost of equity. So whatever you are working with, right now we are working with the annual wage savings. So this is going to be your wage savings. Let's give myself a bit more space here. But it's not the wage savings today. Remember, we always put D1 in the calculation, the future expected dividend. So this is the future expected wage savings, and we divide by the WACC less growth in perpetuity. But we are applying exactly the same logic as Gordon's dividend growth model. So what are the wage savings? They're already after tax, so we've got after tax annual wage savings of $450,000 at current prices. So those are the wage savings today at current prices. If we want the future expected wage savings, we need to increase that by 6% because we were told that future wage increases would grow by 6% per annum. So increase that by 6% to get the future expected wage saving. Here you were given the WACC, it's 14%, and growth in perpetuity is 6%. Calculate your present value. So where you have a recurring saving, use the principles of Gordon's dividend growth model to calculate the present value of that saving today. Please make sure that you are always working with annual cash flows, and please make sure that your cash flows are always after tax. So you can see the calculation over there for the wage savings, and that's the present value. And that is a saving, so please you show that as an inflow. Then there's one more saving over here. Monthly marketing costs of 40,000 Rand before tax would be saved next year with a 5% annual escalation. So, applying the same logic, guys. This is not a once-off saving, this will be a recurring saving, so we need to perform a perpetuity calculation. We've been given the monthly marketing costs. You don't want the monthly marketing cost, you want the annual cost. So you need to take that cost and you need to multiply it by 12. In addition to that, so it's a monthly cost, multiply by 12. The cost has been given to you before tax. You want the after-tax cost. So multiply it by 72%, assuming a tax rate of 28%. Now, please be careful, guys. This must be D1. So it must be the future estimated marketing cost that will be saved. Now, read carefully. You are told that this amount would be saved next year. So that isn't the amount today. If you go back to the wage savings, you were given the wage savings at current prices, so the wage savings today, and that's why you had to increase it by 6% to get the future expected wage savings. With the monthly marketing costs, you've been given the amount that will be saved next year already, so you already have the future expected saving. So please don't increase that by the growth rate. You now divide by the WACC of 14% minus the growth of 5%. Right, because you were specifically told that the monthly marketing costs will have a 5% annual escalation. And that will give you the present value today. All right, so you can see that calculation over here. That was then everything in the question, so that gives you the present value of the specific or unique synergy benefits and costs. Please note, guys, with the monthly marketing costs, that's a saving. So you show that as an inflow. Right. So you've calculated the present value of all general synergy benefits and costs. You've also calculated the present value of all specific or unique synergies and costs. And now I want you to calculate the minimum price, the fair market value, and the maximum price. So let's first calculate the minimum price that the shareholders of Lawson Pty Limited will be willing to accept for the sale of their shares. So remember, when calculating the minimum price, we are doing this from the perspective of the shareholders in the target company. So the shareholders of Lawson Pty Limited. And if you go back to your lecture notes, when calculating the minimum value, we do not take into account any potential synergies that may arise. So if you go back to the information provided in the question, the management accountant of Fury Limited performed the following valuation of Lawson Pty Limited. So we already have the value over here. When calculating the minimum value, we don't take any synergies or costs into account. So you just take this value over here, and you just need to multiply it by 80% because Fury is going to be purchasing 80% of the shares in Lawson. So if we are trying to calculate the minimum amount that they will be prepared to accept, you obviously need to multiply it by the percentage shareholding that they are looking at selling. So that's from the valuation performed by the management accountant. Multiply that by 80%, and that gives you the minimum price. Do not take into account any potential synergies that may arise. Then when calculating the fair value, remember the fair value is the value of the target company in the open market. So we only take general synergies into account in this calculation. So take the value calculated by the management accountant. Then you need to add the present value of your general synergy benefits and costs. So we did already perform that calculation. That's the first calculation we performed. There's the present value of our general synergy benefits and costs. So add that to the valuation performed by the management accountant. And then take that answer and multiply it by the percentage shareholding. So multiply that by 80%. So please, guys, pay attention to where you take the synergies and costs into account in your calculation. It's after owner level premiums and discounts. This value calculated over here is after the owner level premiums and discounts, but it's before you multiply by the percentage shareholding. So after taking into account the owner level premiums and discounts, you then take the synergy benefits and costs into account, and after that you multiply by 80%. So when calculating the fair market value, we only take general synergies into account. Then, if you need to calculate the maximum price that Fury Limited will be prepared to pay for Lawson Pty Limited, if you go back to your lecture notes, when calculating the maximum value, you should include both general and specific or unique synergies in your calculation. So once again, it's not difficult. That's the valuation as performed by the management accountant. Add the value of general synergies and also add the value of specific or unique synergies. So just go back because you have performed those calculations. There's the value of the general synergies and costs. There's the value of the unique or the specific synergies and costs. So just add those. Because we are calculating the maximum price, we include both general synergies and also specific or unique synergies in the calculation. And everything's included before you multiply by the percentage shareholding. So get a subtotal, multiply by the percentage shareholding, and you have the maximum price. Then whilst we're here, there's one more thing that I want to discuss with you, but I don't want you to waste time actually writing this out because it is in your lecture notes. If you go back to your lecture notes, just on the next page at the bottom, this is what I'm discussing with you now. So please don't waste time writing this out. It is in your notes. Rather just follow what I'm saying. But I want to discuss the reason why the acquiring company should not pay the maximum value when buying shares in the target company. So if you go back to the calculations we performed, this is the maximum value that we calculated. So why should Fury Limited not pay the maximum value? Now the first thing that you need to discuss, guys, is the maximum value includes both general and also specific or unique synergies and costs. Now please remember, if there are any other bidders, so if there's any other companies interested in buying Lawson Pty Limited shares, they won't be aware of these specific or unique synergies. They are only aware of the general synergy benefits and costs. So that's why when calculating the fair value or the fair market value, we don't include unique or specific synergies and costs. We only include general synergies and costs in our calculation that all bidders are aware of. So if there was any other, or if there are any other bidders or any other companies interested in purchasing Lawson Pty Limited's shares, they would not offer 21.5 million rand for the shares because they don't know about these specific or unique synergies and costs. They only know about the general synergies and costs. So the maximum that any other bidder would be prepared to pay is just over 14 million rand. So Fury Limited shouldn't pay 21.5 million if the next bidder is only going to come in just above 14 million. If they want to make sure that they definitely, or their offer is accepted, then they just need to make sure that they are better than the fair market value. But they definitely don't need to be better by that extent, because then they are definitely overpaying for Lawson Pty Limited. In addition to that, remember, these synergy benefits over here are not guaranteed. If these synergy benefits don't materialize and Fury pays 21.5 million rand for 80% of Lawson shares, then they are definitely overpaying for the transaction. In addition to that, even if these synergy benefits do materialize, let's say all of these estimations are correct and both the general as well as the unique or specific synergies materialize, and this amount is actually correct. The problem with paying the maximum value is you are paying, or you are giving this full value to the previous shareholders of Lawson Pty Limited because it's included in the purchase price. So if you pay this amount, or if Fury pays this amount, then the full benefit of these synergies are going to the previous shareholders of Lawson, and nothing is going to the shareholders of Fury Limited. So you shouldn't pay the full benefit across, because Fury Limited definitely contributed to that benefit. So it makes sense that the benefit should be shared. So guys, that deals with the reason why the acquiring company should not pay the maximum value. So you can work through that on your own. I have discussed it with you. Then in addition to that, we've calculated three values. We've got the minimum value, the fair value, and the maximum value. And the final bid price, or the eventual bid price, will be a matter of negotiation, and it will be influenced by the following. Now, please, guys, this is very straightforward. I'm not leaving this out because it's not important. It is important, so please, you must work through this. The reason I'm leaving it out is I'm just going to read it to you because it's very straightforward. It doesn't require any further explanation. So please, I want you to read through this on your own. If there is anything that you don't understand or that doesn't make sense, let me know and I can clarify for you, but I don't want to waste your time by just actually reading through this information.